we got some interesting news that came out of last week, and that certainly that will be relevant in the week ahead. And then, of course, there was a lot of activity. Tariffs were on, then they were off, then they were changed, reduced to really just a handful of countries, and then a single flat tariff, pretty much 10% of the rest of the world. But China got hit with 145%. Canada and Mexico, in most categories that would be relevant to the economy, 25%. But the producer price index and the consumer price indexes both came out this week.
Yeah.
And they delivered information that was kind of interesting. And like I would say, esoterically, it looks like it's headed in the right direction, but you have concerns.
Yeah, totally. I mean, look, second month in a row of margin compression. You have producers kind of stockpiling ahead of tariffs, but then you have weaker consumer demand. And of course, businesses are like, okay, we're feeling, the businesses are feeling the squeeze. Consumer confidence is down. Business confidence is down. And then, you look at the prices, producer prices, down on the month, consumer prices down on the month. And then of course you have inflation expectations up, from the soft data coming out of the University of Michigan's, consumer sentiment. So what do we make of this? Well, we're having
that's a question I should be asking of you, sir. What do you make of this?
We have an economy that's slowing. We have an economy that, if you combine both price signals and growth signals, would have resulted in potentially a Fed rate cut, as soon as it's June. But now we have a Fed that's on hold because it's worried about, policy coming out of Washington, D.C. that could be inflationary.
Okay.
All right. And so,
so I'm going to call a quick timeout, and I'm going to translate that. If we weren't pulling all these levers right now at the top of the executive branch of government, you're saying that we would be headed in all likelihood otherwise to a rate cut from the Fed. But because we're trying to do what we're trying to do with regard to resetting the American economy, we're not going to get one now, and maybe not anytime soon.
Well, I mean, the economy was slowing. The Fed was going to act eventually.
Yeah, eventually. I agree with that.
Right. And now there's so much uncertainty that the Fed is on pause. And I think the risk now is, could the Fed essentially miss the boat? Because, with financial conditions tightening.
Good question.
Right. With financial conditions tightening and the consumer pulling back, right, could the Fed miss the boat? And I think it really depends. It's going to depend on whether or not the rise in inflation expectations is reflected in the labor market, right? If consumers start bidding up wages in response to higher prices, right? Then, and inflation expectations become, unanchored, right? Then you have a situation where the Fed cannot possibly cut interest rates. But ultimately, I think the labor market being frozen as it is currently is where I'm likely to see that play out. I don't see, I don't see this wage price spiral, happening. And what it means to me is it means real incomes falling. It means a struggling consumer, and it means an economic downturn. I mean, you look at the risk of recession has gone up, if you.
All right. So I'm going to call timeout again.
Yes, sir.
You use the word. The risk of a recession has gone up, you just said. So what, how will we know here in the next?
Every serious shop looks at this situation and understands that a trade war is going to hurt the consumer. And because of the price increases, by the way, price increases that may or may not actually materialize, because businesses will not be able to pass on the price increase to consumers, right? Then you have businesses basically hunkering down, right? Hiring fewer workers and potentially starting to lay off workers. That's the channel through which you end up with the unemployment rate rising and the economy contracting. So it's not my base case. I think we could potentially still avoid this, but Goldman Sachs had its risk of recession increasing over the past week.
I saw that.
They went 35% to 45%, and then it went up above 60%, and then it went back down after the president pulled back slightly. JP Morgan had the risk of recession up to 60% from 40%. To balance this conversation a little bit, Bank of America still said the consumer is in good enough shape to maybe withstand some of this, right? And so I think I started the week saying the consumer is in pretty good shape. The consumer started the year in pretty good shape.
Yeah.
And that the squeeze may happen, may not happen. The problem is whether or not businesses are going to be able to pass on the price increases to consumers. And whether or not businesses are going to start laying off workers this week, right? Because this is really about the week ahead. We're going to get some data.
Yeah. Let's move over to that. What's coming that you think is going to be useful for our understanding here? We're going to get jobless claims, I think on
retail sales.
Retail sales comes out on Wednesday. So let's talk about that.
Retail sales is going to say a lot. And I think we're going to be paying attention to retail sales.
Will we see enough right now to make any sense of the data? Will there be, we're going to be looking at March retail sales. I mean, has there been enough time in the market for this to make any?
I mean, okay. You would hope you would think you'd have a higher, stronger number with consumers spending ahead of tariffs, right? Remember that when people expect prices to be higher in the future, they go out and spend today, right? They stockpile today.
Yes. Just
to make sure they're not facing the higher prices in the future. And so you would think that retail sales would come in slightly higher than expected.
Okay.
Right. On the strong side. So that's what I think could happen in March. Okay. At the same time, the fact that you see prices declining in the latest CPI and PPI report kind of worry me, right? That perhaps consumers were really not out there spending, potentially because they couldn't. And that's something that should raise eyebrows everywhere. And so we'll pay attention to the retail sales numbers. Are they lower? Are they on the weak side, or are they on the strong side? And if they're on the strong side, I think that gives us a little bit of, I think that should give investors a little bit of comfort. Because if they're on the weak side, you have a consumer expecting higher prices that's not going out to spend. That tells me that that's a consumer that's probably really, really squeezed already. Mm-hmm. And that can't take higher prices, and that can't take a labor market slowdown. And so that is a number you want to pay attention to. And I think the markets will respond to a weaker number. And the response could be swift again. So just pay attention to that. And then, of course, we got some housing data coming out. Builders, you're going to have some builder confidence numbers. You're going to have housing starts and building permits. And again, I expect with confidence falling because of the fear, I expect those numbers to come in a little bit lower on the weaker side. Unfortunately, you at the same time had a lot of units already under construction. You probably have, I mean, the good news for builders is they got some exemptions from these tariffs. So I think that's the positive. But again, housing starts expected to start easing, in the year ahead. And also that's going to play out, right? As all these units that are under construction end up getting completed and delivered, you have to start worrying about construction employment, which so far had been a tailwind, right? And you had seen those construction employment numbers supporting, employment growth across the country.
All right. Well, I appreciate your thoughts as always. We'll call it to an end there, and we'll come back. We have one more episode to tape. We're going to spend some time with what's going on in the housing market, so we can sort of unwrap that a little bit. Things tad softer than maybe some had thought,